If you open your social media feeds or turn on any financial news network right now, you are watching a massive, glittering carnival. AI stocks are going parabolic. Wall Street analysts are tripping over each other to raise their price targets. And everyday retail investors are going all in, terrified of missing out on this so-called super bull market. But if you tear your eyes away from the flashing green screens of the NASDAQ and look at what the smartest, oldest money in the world is actually doing, you will feel a chill run down your spine. Warren Buffett, the Oracle of Omaha, the ultimate champion of buying and holding forever, is quietly executing one of the most aggressive strategic retreats in modern financial history. While everyone else is greedy, crowding around the roulette table, the man who understands market cycles better than anyone alive is cashing in his chips and walking toward the exit. Welcome back to the sanctuary. I'm Aura. Tonight, we are turning off the noisy news cycle. We are not looking at what the talking heads are predicting. We are going to follow the money. We are going to unpack the terrifying yet brilliantly calculated logic behind Warren Buffett's epic cash mountain, and how you can use this exact same logic to protect your own wealth. Take a deep breath. Let's break it down. To understand the game being played, we first have to look at the sheer scale of what is happening. Take a look at this. This is the cash reserve of Berkshire Hathaway over the last few years. For a long time, Buffett comfortably held around $100 billion. But look at the right side of this chart. Recently, that number has gone completely vertical. He is sitting on a cash pile approaching $300 to $400 billion. Let that sink in. Buffett currently holds more short-term U.S. government treasury bills than the Federal Reserve itself. Now, a lot of people will tell you, Aura, inflation is high, cash is trash. Why is the greatest investor of all time letting his money rot in a bank account? That is a fundamental misunderstanding of how smart money works. He isn't stuffing $100 bills under a mattress. He is holding short-term U.S. treasuries, T-bills. And this brings us to the very first reason he is stepping away from the stock market. He isn't selling because he's lost his edge. He is selling because, in this current market, he literally cannot find a single thing worth buying. When you are a value investor, you buy businesses that make mathematical sense. And right now, the math is broken. There is a cruel, unavoidable law of physics in the financial world. It's called mean reversion. Gravity always wins. Eventually, the price of a financial asset must reconnect with the actual boring reality of the business it represents. To measure this gravity, Wall Street quietly watches a specific thermometer. It's widely known as the Buffett indicator. It simply takes the total value of the entire United States stock market and divides it by the total GDP. It measures how detached the virtual economy is from the real economy. Look at this timeline. The red dashed line in the middle is the historical average, the zone of sanity. During the absolute peak of the dot-com bubble in the year 2000, right before everything collapsed, this indicator hit 140%. Before the 2008 Great Financial Crisis, it was around 105%. Where are we today? In a market held up by a tiny handful of massive tech giants, this indicator has shattered past 190%. It is approaching 200%. What does that actually mean for you? It means the stock market is priced at roughly twice the size of the entire American economy. It means the rubber band of valuation has been stretched so far that it is screaming under the tension. Buffett's calculator is telling him that at these prices, every single asset has a terrible risk-to-reward ratio. He knows perfectly well that when gravity finally takes over, and it always does, the people who get hurt the most are the ones who bought at the very top, fueled by FOMO. But there is a second, even more powerful force driving this epic cash hoarding. And this is the ultimate Wall Street chess move that retail investors almost never notice until it's too late. It's about the cost of safety. Let me ask you a simple question. If I offered you a guaranteed 100% risk-free return of 5% on your money, backed by the United States government, completely state tax-free, would you take it? Most people would say yes. Now, let's look at the stock market. Because stock prices are so incredibly high right now, the actual earnings yield, the actual profit the companies are making relative to their stock price, has been crushed. This chart shows a terrifying crossover. The blue line is the risk-free return you can get just by holding a 6-month Treasury bill. It's hovering around 5%. The gold line is the earnings yield of the S&P 500, which has dropped below 4%. Capital has no feelings. It is a calculating machine. Why on earth would massive institutional funds take on the massive risk of a stock market crash to earn a 4% yield when they can sit on their hands, do absolutely nothing, take zero risk, and get paid 5%? This is what I call the siphon effect. Buffett isn't just holding cash. He is executing a perfect asset swap. He is selling the most overvalued, risky assets in history and parking that money into a bulletproof vest that pays him billions of dollars a year just to wait. He has effectively become a shadow central bank, preparing for a liquidity drought. I know that looking at these charts and hearing these numbers can feel overwhelming. It might even make you feel anxious about your own retirement accounts or your own investments. But I want you to reframe how you look at this. Buffett's epic mountain of cash is not a sign of apocalyptic doom. It is actually the ultimate call option on a future global asset fire sale. Think back to 2008, when the markets were in absolute free fall and everyone was panicking. Who was the only guy walking around with a massive checkbook? Warren Buffett. Because he had cash, he was able to buy pieces of incredible companies like Goldman Sachs at absolute bargain basement prices. He is patiently waiting for the fever to break. He is waiting for the blood in the streets, so he can buy great assets at a massive discount. So, what is your action plan? How do you, as an everyday investor, survive and thrive in this macro game? First, learn the art of the strategic retreat. If you have massive paper profits in highly speculative tech stocks right now, don't let greed blind you. Learn from the smart money. It is perfectly okay to take some chips off the table and secure your wins. Second, redefine your cash. Do not let your money sit in a zero-interest checking account getting eaten by inflation. Look into high-yield savings accounts, money market funds, or short-term T-bills. Make sure your defensive money is still working for you, generating that risk-free yield. And finally, protect your liquidity. The greatest opportunities in wealth creation do not happen when everyone is at the party. They happen the morning after, when everyone else is hungover and forced to sell. Protect your capital now, so when the asset discount season of our generation finally arrives, you have money in your pocket and peace in your mind. In the flood of capital, staying awake and staying rational often takes more courage than blindly charging forward with the crowd. This is Aura's Midnight Observation. Sleep well tonight, protect your boundaries, and protect your wealth. I'll see you next time.